Good evening, students. Welcome to the session. Have you revised in the last class what we have done regarding the REIT and the charitable trust that we have started with? Yes, students. Have you revised? Yes or no? REIT was a very important topic that we discussed. I told you you have to revise the REIT concept. Good evening, Shankara. Good evening, Salish. Yeah. Good evening, Pradeep. So I'll just quickly recap what we had done for the REIT taxation. So if you recollect, I told you that the first case is that where the sponsor of the SPV will exchange the units, will exchange the shares of the SPV for units of the REIT. In that particular case, this is not considered as transfer under 47. Also, the notional gain or loss which is arising will not be subjected to the MAT calculation, right? That is number one. Then, in case when the units of the REIT are sold, at that time there will be the capital gain and even the MAT will happen also, because those profits will also be considered. The actual profits or losses will be considered even for the book profit calculation. And the STCG is going to be taxed at 15%. LTCG over 1 lakh will be at 10%. What will be the cost of acquisition? The cost of the shares. The period of holding will be clubbed of the shares. And that is how the capital gain will be computed. The period of holding is going to be 36 months. Now, when the REIT will start generating the income from the rental income that it will generate from the real estate property when it is directly investing, so the income will be exempt under 1023 FCA in the hands of the REIT, no TDS. In the hands of the unit holder, this will be taxed in a like manner and to the same extent. There will be TDS under 194 LBA, 10% for resident, non-resident rates in force. It can generate the income from SPV through interest or dividend. Interest which is there again is exempt in the hands of REIT under 1023 FC. Whereas in the hands of the shareholder, it will be taxed in the like manner. Only the interest from the SPV. Any other interest that the REIT generate will be taxable at MMR in the REIT's hand, right? Now, in the hands of resident, taxed at normal rate. In the hands of non-resident, 5% under 115A. TDS under 194 LBA at the rate of 10% for resident, for non-resident 5%. For the dividend, again it is exempt under 1023 FC for the REIT, no TDS for unit holders. The question will be whether the SPV has exercised the tax rate under 115 BAA. If yes, then tax in the hands of unit holder under 115 UA, which is in the like manner and to the same extent. For resident, normal rate, TDS 10%. Non-resident 10% under 115A, TDS also 10% under 194 LBA. Right? Then, in case it is SPV has not exercised the tax rate under 115 BAA, the dividend is exempt even in the hands of the unit holder. Any other income, if it is LTCG under 112, then in that particular case, it is taxed at 20% or 10% under that section. STCG 15% under 111A and any other income at the MMR. And this will be exempt in the hands of the unit holder. Now the REIT, which it will pay, let's say for example, interest to a non-resident on the loan borrowed. So this will be taxable at 5% under 115A, TDS under 194 LC. If it is under IFSC listed, then 9% after 1st July 23 and 4% before that. So that was about the REIT, and then of course the sum paid by the REIT, which is in the form of the repayment of debt, now will be taxable under 56(2)(12), which will be A minus B minus C. A is the sum distributed, B is the cost of acquisition, and C is the amount, if any, taxed earlier. Yes, students. Any questions for the REIT before we move further? Okay. Now going back to the charitable trust that we had started with. We had two regimes, the first regime and the second regime. Under the first regime, 1023C, you have a specific trust which is covered. You have the educational institutions existing solely for the educational purposes, right? Or the hospitals which are existing only for philanthropic purposes. That is number one. Sorry, number two. Then solely for then the condition is that these are substantially financed by the government. What is substantially financed? The government grants are greater than 50% of the total receipts. Third is the educational institutions existing solely for educational purpose and if their annual receipts are less than 5 CR. Or hospitals which are existing not for profits if the annual receipts are less than 5 CR. The combined receipts of the educational and the hospital should be less than 5 CR. For all these three A, B, C category, you have the unconditional exemption, meaning you don't need to apply for any approvals. Are we getting that? But in case you are not falling under either of this, you have to apply for the approval. So the exemption under 1023C is subject to the approval. What do we mean by the solely for educational purpose? We understand the Supreme Court judgment in the case of the New Noble Society, where we said that solely in education does not mean that it should be predominantly in education. Solely does not mean predominantly, it means the exclusively. If there could be incidental income, but for that separate books of accounts should be maintained. The objective should not be to earn the profit. The objective should be to impart the education. Earning of surplus, although is no bar for exemption. But the objective is to be imparting the education. Then we went to the second regime, which is the charitable and the religious trust. For that, we looked at the Ahmedabad Urban Development Authority case, which talked about the charitable purpose, where one of the objectives is to advancement of the general public utility. Advancement of any other object of general public utility. Because charitable purpose is defined under section 215 to include the relief of poor, education, yoga, medical relief, preservation of environment or monuments, and advancement of any other object of general public utility. So when you are looking into that, you have to see that if there is any incidental income, and if you are maintaining separate books of accounts, that is fine. Even that will be covered. Because this excludes carrying out of any activity in the nature of trade, commerce, or business. So any incidental activity which is supporting the main objective, which is in line with the main object of general public utility, that does not mean that you are engaged in the trade, commerce, or business. But what you need to identify is that whether the markup on the cost is nominal or significant to determine whether you are into trade, commerce, or business. Now, if you are into the trade, commerce, or business, you can only come out of that only when you fall in the exception, which is if the activities are undertaken in the course of the advancement of the objective of general public utility and receipts from the activity are less than 20% of total receipts. Yes, students. Is it fine? Good evening, Viraj. We are fine till now? Yes or no? Yes, faster. Okay. So let's start with then the computation of the income from the trust. Let's start. Now, this is going to be very, very, very important. So be very attentive. Write down. Statement of total income. First, we'll start with respect to the income of the charitable trust and institution. Now, this is equivalently applicable to both the regime 1 and the regime 2. Now, first is the income from we start with the income from property held for charitable or religious purposes in India. So income from property held for charitable or religious purposes in India. Now, if you look at it, or you can write income derived from, let's write like this. Let's use the wordings of section 11 itself. Income derived from. Income derived from the property held for the charitable or religious purposes in India. So, here the wordings, if you look at it, it talks about income derived from. Income derived from the property which is held under the trust for charitable or religious purposes. So first of all, it talks about the word income. It talks about the word income. Now, if you look at the word income over here, whether this means the gross receipts or whether this means the whether this means the gross receipts or the net receipts. Net receipts meaning income minus expense. So both views are plausible. One can say that this includes the gross receipts only, the income includes only the gross receipts. That's one view. That you will not reduce any expenditure over here. Now, why this is very, very important, you have to understand the fact that because when particularly you are going to calculate the 15% threshold, the 15% ad hoc exemption that you get, we are going to talk about that. So at that point of time, you are going to calculate the 15% out of the gross receipts or out of the income minus expenditure. Are you getting my question? So let's take for an example that I have here the gross receipts which are, let's say, 10 lakh rupees. Now, I have expenditure of, let's say, 2 lakh rupees. So here, whether I will consider 8 lakh or whether I will consider over here 10 lakh. Because when I will calculate that 15% exemption, I will have to consider that exemption 15% from the 10 lakh or from 8 lakh. Yes, students, are you getting my question? Good evening, Geeta. Thank you, Shankara. Yes, what do you think, students? 10 lakhs or 8 lakhs? So as I said, both are plausible views. One can say it should be gross. Yes, Mansha. But on the other side, since the word used is income, income always means the receipts minus the expense. Income is never the gross receipts. That's the second view. What is the ICAI's view? We are going to solve a sum on this particular point. That's why I'm raising this point at this particular moment. So ICAI's viewpoint is it should be the gross receipts. So in case you get a question in the examination on this particular point, you will consider the income, means the gross receipts and not the income minus, gross receipts minus expense. Are we clear? Yes or no? So just write down over here. Income here means the gross receipt. Okay? Fine. Second one. So once you include the income derived from the property held under the trust. Second is the voluntary contributions. Second is the voluntary contributions that you receive. Fine. So this was the first category that we spoke about, which is the income from the derived from the property held under the trust, which is derived for the property which is held under the trust for charitable or the religious purposes in India. Okay, so this is particularly for the charitable or religious purposes in India. Now the trust can also receive the voluntary contribution. The trust can also receive the voluntary contribution. Now, any voluntary contribution received by the trust will be deemed to be the income derived from the property held under the trust. Will be deemed to be the income derived from the property held under the trust. So, first one, the income derived from the property held for charitable or religious purposes, that is covered under section 11. And then section 12 of the income tax said that the voluntary contribution received by a trust which is created only for charitable or religious purpose will be deemed to be the income derived from property held under the trust. Other than the contributions which are made with a specific direction that they will form part of the corpus of the trust. So write down. Other than made with specific direction to form part of the corpus of the trust. So that means what? That the voluntary contributions which are forming the part of the corpus of the trust are not to be included. So what we have to first include is the income derived from the property held for the charitable religious purposes. Second is the voluntary contributions not forming part of the corpus of the trust. So other than that, whatever voluntary contributions you receive, that will be considered as taxable. Fine. Now, with respect to the corpus donation, now we'll talk about that. What is the corpus donation? Now, these are the donations which are the contributions which are received, which are given with the specific direction that they will form part of the capital of the trust. And they have to be invested in the modes specified under section 11(5). What do we understand by the mode specified under section 11.5? I'll talk about that. So section 11, subsection 5 gives out certain modes where you can invest the amount of the contributions that you receive. So section 11.5 of the Income Tax Act gives the form and the modes of investing or depositing the money that has been received by the trust. Are we getting that particular point? So any amount which is received for the corpus of the trust has to be invested in these modes. What are the modes? In the saving certificates by the government, post office saving bank account, with the cooperative banks, with the debentures issued by the public company or by the central government, long-term finance institutions, any bonds or deposits issued by them. So basically, this has to be invested in the long-term deposits with the government. So any corpus money that you receive, that has to be deposited only in the mode specified by under section 11, subsection 5. Are we getting that? So just write down corpus donation, first, no, you can divide it into two parts. Not considered as income, provided deposited in modes specified in section 11, subsection 5. Are we clear? Now, second type of corpus donations which are there are the donations which are received for repair and renovation by the religious trust. The donations which are received for the repairs and renovations of the religious trust. Now, what does that mean? Let's try and understand. So, in case, let's say, for example, a charitable trust is there. Now, this charitable trust or the religious trust, not the charitable trust, receives the donation for the repair or renovation of the temple. Now, again, whatever contribution it is receiving for the purpose of repair or renovation of temple, which is a religious trust, only for that I'm talking about. This only applies where the property is held under a trust which includes a temple, mosque, gurdwara, church, all of that kind. Now, in case any sum is received as a voluntary contribution by such trust or institution for the purpose of renovation or repair of such temple, then this will be treated as the corpus of the trust. Now, this will be not considered as income, obviously, if it is treated as corpus, if it is applied only for the purpose for which contribution is made. It is not utilized for making donation or contribution to any other person, and it has been invested or deposited in the mode specified in section 11.5. In case any of these conditions are violated, then it will be deemed to be the income during the year in which the violation will take place. Okay, this will be treated as the income in the year in which the violation is being taking place. So just write down over here. Donation for repair or renovation of donation for repair or renovation of the religious trust. Okay, now this will be treated as corpus donation provided is applied for the purpose for which contribution is received, not utilized for making contribution or donation to any other trust separately identifiable and invested or deposited in modes specified in section 11 subsection 5. Okay, so what did I tell you? Corpus donation which are towards the objective will not be, so corpus donations which are received will not be considered as income at the first place. Secondly, in the corpus donation, whatever amount is being received for the repair or the renovation of the temple, that amount will also not be considered as the income that will be considered as corpus if these conditions are fulfilled. If any of this is violated, this shall be deemed to be the income. This shall be deemed to be the income. Yes or no? Any doubt? Any questions? Yes, students. Is corpus donation clear? Yes or no, dear students? We are clear with this particular point? Okay, so I'll just quickly recap. What we have done is, we are talking about first the income derived from the property held under the trust. What is the property held under the trust? Property held for charitable or religious purpose. Right? We have understood what is a charitable or religious purpose under 215. We have already spoken about it. Includes the advancement of any other object of the general public utility. Where advancement of any other object of the general public utility means that there has to be some advancement for the public. There should not be any profit motive. Are we clear? So where you are under obligation to apply the income for the development of the object of the general public utility, then in that particular case, only you will be considered as the charitable purpose. But if you carry out any trade, commerce or business, then it is not considered as the object of the general public utility. Okay. So we have seen already the case laws on that particular point as well. And then that is the income derived from the property held under the charitable or religious purposes. Secondly, it is the voluntary contribution which will not be considering the corpus donation. Are we clear? Yes or no? Any doubt? Yes, students. Yes, one question to you. Let's say, for example, there is a trust. One question to you. There is a trust whose main objective is to have the relief of the poor. And this trust receives rupees 30 lakhs from a trading activity and its total receipts are 140 lakhs. So total receipts of the trust is 140 lakh. Trading receipts are 30 lakh. Whether the trust will get exemption, whether it will be considered as charitable purpose for section 11. The object of the institution is relief of poor. Total receipts 140 lakh, trading receipts 30 lakh. Yes. What do you think? Yes, students. Krishna, no. It will not be considered as charitable. Very good, Mansha. Satish, no, because trading receipts is less than 20%. Geeta, you are saying yes, entire amount is allowed. Good evening, Namrata. Yes or no? Very good, Mansha. Yes, so your trading receipts are 30 lakhs and your total receipts are 140 lakhs. So whether you will be considered as the engaged in the objective of charitable purpose. My question to you. Krishna, for that here exemption is not available. No, it is not for that here. You will not be considered for charitable or religious purpose itself. It is not for a particular year. You have to check whether you are engaged in the charitable or first of all religious purpose. And if you are into trading activity, you will not. But whether your 20% threshold will apply. Prerna, no. Okay. Salish, you are saying no, not eligible. So those who have said not eligible are, all of them are incorrect. I said the objective of the trust is relief of poor and not advancement of any other object of general public utility. The condition of 20% is only for advancement of any other object of general public utility. That it should not carry out any trade. But relief of poor is not having that 20% threshold. So when I said that the object of the trust, yes, Geeta, very good, is relief of poor, then you will not apply the threshold of 20% or the restriction of carrying out of the trading activity over here. So even if the trading receipts exceed 20% of the total receipts, the institution can still claim the exemption under section 11 Because the object is the general public utility. Oh, sorry, the object is relief to the poor. Yes, Satish, very nice. Okay, so that is the trick. You have to understand what is the objective. Are we clear? So section 215, if it uses the objective relief of poor, preservation of wildlife, then it will not be subject to the further restriction of advancement of the restriction of the trading receipts not being there. It is only for the advancement of any other object of the general public utility. So even in case where the trading receipts exceed 20% of the total receipt, the institution will not lose out its charitable status. Are we getting that? Yes or no? So that is only for the advancement of the any other object of the general public utility. If the main object of the institution is the advancement of the any other object of general public utility, only then the 20% threshold will be applicable. So you can write it over here. This restriction is only for advancement of object of general public utility and not for other objectives listed above. Yes, students, fine. Any doubt? Yes or no? At least answer me. Did everybody understood this particular point? Okay. Yes or no, students? I'm not getting the answers. Okay. Yes. Okay. Perfect. Okay. So let's proceed then further. Now, there is one more important point that you should remember is that the promotion of the sports and the games is also considered as a charitable purpose by the CBDT. So CBDT has clarified that the promotion of the sports and games is also considered as the charitable purpose. And therefore it can claim the exemption under section 11. So if the objective of the trust is carrying out any activity which is in relation to the sports and the games, the trust will not be denied exemption on the ground that its objects are non-charitable. Okay? So you can write down over here. CBDT circular clarifies promotion of game and sports is charitable. Sorry. Okay. So this is a very old circular of CBDT which clarifies of 1984 that tries to clarify that the promotion of the sports is also considered as the object of the charitable objective basically, and therefore this will be entitled for the exemption under section 11. Fine. Now, another important point with respect to the charitable trust. Now, if the charitable trust is engaged in the business activity, as I said, whether under regime 1 or under regime 2, then that business should be incidental to the attainment of the object and the separate books of accounts should be maintained. If that is not incidental, only then the exemption will be denied. Then the exemption may be denied. Are we clear? So basically you can write down here charitable trust engaged in business activity, whether under the first regime or under the second regime. You can write here business shall be incidental to the attainment of main objects of the trust and separate books of accounts shall be maintained for such business. Okay. Fine, students. So basically for the charitable purpose, you can have the any other business activity per se. But for the advancement of any other object of general public utility, the condition is that it should not be engaged in the nature of trade, commerce or business unless the activities are in the course of advancement of the objective of general public utility and the receipts are less than 20% of total receipt. Now, this is only for this particular clause and not for relief of poor, education or preservation of environment, all of those clauses. Okay. Then how do you determine trade, commerce or business? As per the Ahmedabad Urban Development Authority judgment, you have to identify whether the markup on the cost is significant or nominal. If it is significant, then you test the exception, whether the activities are in the course of the advancement or whether the receipts are less than 20%. If the markup is nominal, then this is absolutely incidental activity. You need not go into even the exception clause. And basically, if you maintain the separate books of accounts, if the activities are incidental, it will also be considered as charitable activity only. Okay. So that is the limited point that we wanted to discuss over here. Fine. Okay. So let's say, for example, if you have any business activity, but you are applying the income of that business activity for the charitable purpose itself, and you're maintaining the separate books of accounts, then in that case, there is no problem. That will also be entitled for the exemption under section 11 or even similarly under section 1023C. So now again we get back to the computation, the statement of total income that we were talking about. Now, as far as the statement of total income is concerned, as I said, the income from the property held under the trust, and secondly, we have the voluntary contributions other than the corpus donation. So, corpus donation will not form part of the total income. Third is income from the government grants or the subsidies. Third income which a trust can have is income from government grants or the subsidies. Okay. Next next income that it can have is the anonymous donations. Now, with respect to the anonymous donations which are there. Now, anonymous donations mean what? Any idea? What do we mean by anonymous donation? Anyone? Any idea regarding what do we mean by the anonymous donation? Yes or no, students? Okay. So, anonymous donations basically, yes, Prerna, you're right. No, no, Mancha, that is not donation for political parties. It is not from political party. Anonymous donation are not from political party. Yes, Geeta, you are right. These are donation from the person whose names are not known. So basically what happens is, see, these trusts which are charitable or religious in nature, they may be getting lot of donations. Some of the donors give the name, some of the donors do not give the name, right? So we are not aware about what are the basically some of the donors who may just not give their name, they may just, you also go to temple so many times or Gurdwara so many times. You just put your amount into that box which is there. So nobody knows basically who is the donor. So these are the anonymous donation. Anonymous means unknown donation. So these donations are not known. So if these donations are not known, then in that particular case, these are called as anonymous donations. Now, these anonymous donations are considered as the income of the trust. But now, one question which arises in the context of trust is to how much is the anonymous donation going to be taxed? See, it is quite possible that they may collect majority of the amount through the anonymous donation and the donors may just start giving this amount by converting black money into white. By just putting this amount, howsoever it is possible. Are you getting that point? So there is no traceability of that. So in order to restrict that particular thing, the provision has been saying is that not entire amount will be considered to be exempt. Not entire amount will be considered to be exempt. So then what is the amount that is considered to be exempt? So for anonymous donation, the higher of 5% of the total donations or rupees 1 lakh, whichever is higher, will be considered as the normal donation. Balance will be taxed at 30%. Are we getting that? So the exemption limit is higher of 5% of the total donations or rupees 1 lakh. And the donation exceeding that limit will be taxed at 30%. Okay, so just write it over here. So 5% of total donation or rupees 1 lakh, whichever is higher. Now, what do we understand of 5% of total donation? Total donation here means it includes the corpus donation as well. For the purpose of computing the 5%, it means total donation. So, whatever donations you may get. Voluntary contributions as well as the anonymous donation. So here you have to consider the total donations, which will even include the corpus donation and the anonymous donation. The excess amount which is there, the excess donation which is there, will be taxed at the rate of 30%. Excess donation will be taxed at the rate of 30% under section 115 BBC. Under section 115 BBC. Okay. So let's take an example over here. I'm writing it over here only. Let's say, for example, my total donation is, let's say in first case, 15 lakh. Second case, it is 30 lakh. And third case, it is, let's say, 40 lakh. Right? My anonymous donation are, let's say, 4 lakh, 7 lakh, and 10 lakh. So yes, what will be the exemption and what will be taxable at higher rate? Yes, you have to calculate it for me. Yes, faster in all the three cases. Faster students. Yes, in the first case, Exemption will be 5% of the total donation or rupees 1 lakh. Now, what is my 5%? 15 lakh into 5%, 75,000 or rupees 1 lakh, whichever is higher. So, this is coming to 1 lakh rupees. Yes, Geeta, you are correct. Okay. So, in the first case, yes, Namrata, you are correct. It is 1 lakh. Satish Kumar, how is it 1.3 lakh? So, then the AD taxed at 30% will be 3 lakh. AD that is taxed at 30% will be 3 lakh and donations subject to normal tax will be 12 lakhs. Right? In this case, 7 lakh into 30 lakh into 5%, 1.5 lakh. So here it will be 1.5 lakh. Satish, I think your calculations has some mistake. Yes, Geeta, you are correct. Namrata, yes, correct. Sailesh, correct. Yes, Prerna, correct. In the third case, it will be 2 lakh. Right? So this will be 5.5 and 8 lakh. Okay, I get your Satish calculations. You are writing about AD. So this will be 24.50 lakh and this will be 32 lakh. Okay. Now whether I can consider this amount for the statement of total income for the purpose of application of 15% and the other application, or I have to directly tax these donations. So I have to consider these amounts over here. So these are eligible for application of the income. These are eligible for the application of income. Also, this anonymous donation, this particular clause is not applicable in cases of the trust which are for wholly religious purposes. So this provision does not apply to the trust for wholly religious purpose. Are we clear? So these are not applicable for the wholly religious purposes. Clear? Even in the case it's partly charitable, partly religious, in those cases also this will not be applicable. Unless the anonymous donation is made with a specific direction that this has to be given to some university or hospital or educational institution. Other than that, for them also, this is not applicable. Wholly religious or partly religious and partly charitable purpose. Meaning this is applicable for the charitable trust and not for the religious trust. Fine. Then the last one that is there under the income is capital gains, which is my sale consideration minus the indexed cost of acquisition. Okay. Yes or no? Fine. So that is about the income category of the trust. Now, before we move further towards the application of the trust, I want you to go through the entire provision that we have. I'm just giving you 1 minute time to go through and let me know in case you have any doubts. Now we are because moving towards the application of the income. We are done with the gross total income. Okay. Shall we proceed further? Fine. Now we move further towards the application of income. So this is going to give me the result of the gross total income. This is going to give my gross total income. Now the first one that I will have is less ad hoc exemption of 15%. Ad hoc exemption of 15%. So this is the first application of income that I will have, which is the ad hoc exemption of 15%. So I get basically the ad hoc exemption of 15% as which is allowed towards the application of income. So I am allowed that 15% amount as the application of the income, 15% of the total income which I have. That I am allowed as the ad hoc exemption. There's no question asked on that. So that is the first point that you have to take into consideration. So when you allow the application of income, the application is generally limited to the amount that is applied. So it is not necessary, the question which always comes up is that, is it necessary that the entire income should be so applied? So the act is giving you the concession over here. It is not saying you apply your 100% of income. So you can claim the exemption even if the trust applies 85% of the income derived from the trust. The 15% of the income is ad hoc allowed as exemption. So the 15% is giving you the ad hoc exemption. And for this 15%, you will consider of the gross total income. But the 85% which remains, that has to be applied towards the object of the trust. So 85% of the income must be applied for the purposes for which the trust has been created, whether it's relief to poor, whether it is advancement of the any other object of general public utility, whatever objective is there. The balance 15% can be freely accumulated or set apart for application to the charitable or religious purpose in India. So that 15% leeway is given to you. Either you accumulate or you set apart to be applied in future. We will not ask you much question. But the pre-accumulation after 15% is not allowed. This is allowed only up to the 15%. Are we clear? So balance 85% must be applied during the previous year for the purpose for which the trust has been created. Fine. Now it is possible that the trust is unable to apply the 85% during the previous year itself. Either because it has not received the income during the year. Because let's say, for example, the trust is following the accrual system of accounting. So it has accounted for the income during the year, towards the year end. But let's say it has not received the income. The income is received in the next year. Now, when I have not received the income, how will I apply the income? Are you getting my point? So I have followed the accrual system of accounting by which I have recognized the income. But how can I apply? I don't have the money. Right? I have not received the money as yet. Or it is possible that let's say the income is received only on let's say 20th of March, 15th of March. So in 10, 15 days, it's very difficult to apply the income. It is well received very late. So in these cases, the Act gives them some kind of leverage. It gives them some kind of extension. What is the extension that the Act gives? We are going to talk about it. But I'm just putting out the point over here that the Act is giving certain exemption on these two situations. What are the two situations that I'm talking about? Number one, the income has not been received during the current year. The income is not received during the current year. Secondly, it is received very late, at the fag end of the year. Now, in both these situations, the Act gives some kind of leverage to the assessee. See, when you follow the cash system of accounting, you will not consider the income only on the accrual basis. So, income will be accounted only when you receive it. So, there is no question of any problem at that particular point. Similarly, the expense also will be allowed to you only on the payment basis. But when you have the accrual system of accounting, there is the problem. So in that case, what does the Act provide? Just write down. So now we are talking about balance 85% of the income. Okay. So first is, if income or you can write inability to apply the income due to accrual system of accounting being followed, where the income is accrued but not received. Or second situation is income is not received or income is received very late. During the year. So, in the first situation, where the income has not been received during that year, then the Act provides that there will be the deemed application There will be the deemed application. So in that particular case, we will not consider that even if you have not applied 85% during this current year, because you have not received the income, we will consider it as deemed application. We will consider it as deemed application of income because we understand there is no fault of yours. We understand that there is no fault of yours, so this will be considered as deemed application in this particular year. But the condition is once you receive the amount should be applied in the next year when you are receiving the amount or in the year following that. In case you do not apply the amount, in the year in which it is received or maximum in that next year of that, this will be considered as deemed income of that particular year. Are we getting this particular point? So what the act is trying to say you is that the income which you have received, not received, and if you are not applying it, then in that particular case, it will be considered as the income, deemed income of that particular year. Okay, so just write it down over here. This shall be deemed application. Let's say we are talking for previous year 23, 24. The condition is, what will be the condition over here? This income should be applied when it is actually received in the previous year in which it is actually received or in the year following to that year or previous year, or you can write down next following previous year. So basically, let's say I'm talking about 23, 24, I have not received the income. It will be considered as deemed application. Let's say I received the income in previous year, 24, 25. So I get two previous year 24, 25, previous year 25, 26 to apply the income. If I do not apply the income by previous year 25, 26, then this will be considered as deemed income in previous year 25, 26. Non-application of income either in the previous year of receipt, which is previous year of 24, 25, next following previous year, which is 25, 26, will be considered as deemed income in previous year 25, 26. That is in the last previous year. Sorry. Okay. Now, when you apply this income in the next year, that will not be considered as application of income of that year because you have already considered as deemed application of this year. Are we clear with this point? Yes or no, student? Yes, Mansha, I gave you the time limit for utilizing the amount also. We will talk about that. First, are we clear about this particular point? Yes or no? So if I am not receiving the income during the current year, then this is the deemed application leeway that has been given to me. Okay? Then in that particular case, I can consider it as deemed application provided I am applying in the year of receipt or in the next following year. Clear? Yes or no? Yes, students. Okay, fine. Now the next category is income received late during the year. So if I have received the income late, then also it will be considered as deemed application. Then also it will be considered as deemed application, but the condition is you have to apply the income by the next year. By the next year, you need to apply the income. So basically, you have to apply the income by the next particular year. So that is the again deemed application of the income. So it will be considered as deemed application in the current year, but the amount needs to be applied in the next previous year. If again the amount is not applied, then income will be deemed to be the income of the next previous year. Are we clear? So just write down. Condition. Here you don't get 2 years to be applied by next previous year, which in our case will be previous year 24-25. If income is not applied, deemed income of previous year 24-25. This will not be considered as deemed income of the current year. This will be deemed income of the year up till which you were allowed the time limit. Yes. So this is the category of the deemed income which is existing under the law. Deemed application, sorry. So let's say, for example, during the previous year, you have received only, you have earned, let's say, 1 lakh, but you couldn't receive, let's say, 40,000 out of that. So now this 40,000 will be considered as deemed application, provided you have to apply this particular amount by 24-25 or 25-26. If you receive the amount in 24-25, to apply by 24-25, 25-26. If you do not apply, it will be considered as income of 25-26. Or if you receive the amount, let's say very late, you have to apply by the next particular year. Are we clear? If you cannot apply, that will be considered as the income of the next year. Yes. So this is particularly the point which is there. Now for exercising the option that you get the deemed application, this deemed application is not automatic. You have to exercise the option for availing this extended period of 2 years or 1 year in case the income is received late. So the trust has to make an option. It has to exercise an option by filing one form, which is Form 10. And this has to be filed 2 months prior to the due date of filing the return of income. Okay. So this has to be filed by the 2 months prior to the due date of filing the return of income. So just write down Form 10, option to be exercised by filing Form 10. What is the time limit? This is the amendment. Earlier it used to be with the return of income. Now the time limit is 2 months prior to the due date of return of income. Therefore, the return of income due date is September. So basically, October. So you have to file by August. So 2 months prior to that, you have to file by August. Okay, fine. So basically, when you are exercising this option by filing the Form 10, only then it will be considered as deemed application. Also, remember one point, once it is considered as deemed application of this year, it will not be considered as application of the year in which it is actually applied. Because you have already considered application for previous year 23-24, it will not be considered as application for 24-25 or 25-26. You have to apply it, but it will not be reduced from your income. Okay? Yes or no? Any doubt? Okay? Yes. This is the option which is only available to the trust which are there under the second regime. So you can write here option available only with trust under second regime and not first regime. Also here you can write the clarification. Application of income will not be again considered for the next previous year, since already considered as deemed application for current previous year. Fine. Charitable trust, the due date is Geeta 31st October, because it is required to get the books of accounts audited under their local trust laws. So there are state trust laws which are there, and you have to get your books of accounts audited. So for them, it is 31st October. Okay. So let's take a quick break of 10 minutes and then we get back. Let's take a break of 10 minutes. Yes, students, clear? We'll start with it ahead now. Okay. Now, as I said that you have to utilize the balance 85% of the income. You have to utilize the balance 85% of the income. So as I said, for 15%, under both the regimes, they permit the accumulation of 15% of income. Either you want to accumulate, either you want to set apart, you want to utilize for the objects, whatever it is. But the main condition for the grant of the exemption under both the regimes is that the income, 85% of the income which is there, that has to be applied for the main objective of the trust. That is the main condition for granting the exemption. In case the income cannot be applied during the previous year, the same can be accumulated and applied for the purposes even in the future. So as I said, one of the condition is that if you did not receive the income during the year or you received it very late. Other than that, in case you have received the income also, not late also, but still you are not able to apply the income, 85% of the income, then the Act says you can accumulate for a period for 5 years, maximum period of 5 years. Again, for that, you need to submit the Form 10. You need to submit the Form 10 to the assessing officer. And you have to, if you are accumulating the money, if you are not utilizing the money during the current year, and you are accumulating the money for the period that you are saying, or for a maximum 5-year period, then the money so accumulated has to be invested or deposited in the specified modes only. So for accumulation of the income, in case you're saying I'm not applying the income, it is other than these two cases where the income is not received during the current year or it is received late. Other than that also, in case you're not applying during the current year, you want to accumulate, then you have to furnish the Form 10 stating the purpose for which the income is accumulated. That why you want to accumulate, why you do not want to apply it in the current year. And the period for which you want to accumulate. The maximum period you can accumulate is 5 years. So that you have to state in Form 10 to the AO. And till the time you utilize that amount, you have to deposit the amount under the mode specified in Section 11.5. Are we clear? In case you do not furnish Form 10, then the benefit of accumulation would not be available to you. Or you do not furnish your return of income only, then the benefit of accumulation will not be available. So in case you submit Form 10, it will be considered as application of income. Okay. So as per Section 13(9), in case the Form 10 is not submitted on or before the due date under 139(1). So although the due date of Form 10 is 2 months prior to the due date of return of income. But as per Section 13(9), they have not amended there that the due date of now Form 10 is, because this has been amended this year. So Section 13(9) says that if you do not submit the Form 10 by the due date of return of income, then the income will be taxed if you do not submit the Form 10. However, CBDT has now clarified that Form 10 has to be submitted 2 months prior to the due date of furnishing of the return of income. However, if you are accumulating the income and you are not submitting Form 10, then you are given that extended period that you can submit Form 10 by the due date of return of income also. Ideally, the due date is 2 months prior to the due date of return of income. but the exemption will not be denied to you in case you are not submitting the form 2 months prior to the due date, but you are submitting the form by the due date of return of income. Are you getting that point? Yes or no? So, the due date for filing Form 10, just now I said, is 2 months prior to the due date of return of income, which is 31st August. But Section 13 of the Income Tax Act, which denies the exemption, it says, in case you do not submit the form by the due date of return of income, because earlier the due date of Form 10 was the due date of return of income. It used to be the same. This year, by Finance Act 2023, this year they have preponed the time limit for Form 10, but they have not made the consequential amendment in Section 13. So Section 13 still says if you do not submit Form 10 by the due date of return of income, that is by 31st October, then we will not allow you to accumulate income, and this will be considered as the taxable income. We will not consider it as application of income. So CBDT has clarified that although the due date for Form 10 remains 31st August, which is 2 months prior to the 139(1) due date, but you will not be denied the exemption if you do not file the Form 10 by the 2 months due date prior to the return of income. But if you file the Form 10 by the return of income due date, even if you file it belatedly, but you file by the due date of return of income, we will still allow you the application of income for the accumulation that you are going to do. If after the due date of return of income you are furnishing the Form 10, we will not consider it as accumulation. We will consider it as taxable income. Are we clear with this point? So you can write down. You can write down. Yeah. So accumulation of income, 85% of income can be accumulated for specified purpose and for period less than 5 years by filing Form 10. By filing Form 10. What is the due date? 2 months prior to the due date under Section 139(1). So 85% of income can be accumulated for specified purpose and for period less than 5 years by filing the Form 10. Plus, it should be invested in modes specified in Section 11, subsection 5. Okay, it should be invested in the mode specified in Section 11, subsection 5. Now, here what did I say? For the accumulation of the income, you have to submit the form to the AO, accumulate the modes in mode specified under Section 11, subsection 5, plus file the return of income. sorry, by the due date under 139. The return is filed under 139(4)(a). Here you can write CBDT circular clarifies that the CBDT circular clarifies that the income accumulated, or 1 second, you can write like this. If Form 10 is not submitted, or let us put it over here, it will be easier for you. If Form 10 is not submitted, then on or before the due date of return of income under section 139(1), then benefit of accumulation is not available and income shall be taxable. Okay, so CBDT has permitted that the statement of accumulation in Form 10, although it is required to be furnished at least 2 months prior to the due date, however, the accumulation will not be denied as long as it is furnished by the due date of 139(1). So although the due date is this, but if Form 10 is not submitted before the due date of return of income, then only the accumulation is not available. So this is the another category of deemed income, deemed application. This shall be deemed application. Okay. So you can write, although due date of Form 10 is 2 months prior to the due date under section 139(1). However, even if filed before the due date under section 139(1), benefit of accumulation shall be available. However, this is applicable only for the accumulation. This is not applicable for the earlier case, which is if the income is not received or received late. Okay, so this extension is not available in the scenario where deemed application is on account of income not received or income received late. Yes, students, did you consider this particular point? Are we clear? Yes or no? Yes or no, students? Yes, students, faster. Yes or no, students. Okay, fine. Let's proceed further. Now, what are the implications? What are the implications in cases where, let's say for example, the conditions are not fulfilled over here. Now, here there are conditions. One is Form 10. Second is I have to invest in the mode specified under Section 11(5). Third is filing the return of income. Now, what if I fail to satisfy the conditions of the accumulation? What are the repercussions of that? So let's say, for example, I have to accumulate the income up to 5 years. Now, in case of violation, for the condition, for example, the condition is I have applied for purposes other than the charitable or religious or the purposes which are not in accordance with the object of the trust. Or I have not invested in the mode specified in 11(5). Or I have withdrawn the funds. I have not accumulated. I have not utilized for the purpose for which it was accumulated. Or it is paid to some other trust itself. Then in that particular case, there will be deemed income which will be coming into picture. So where the accumulated income is applied to the purposes other than charitable or religious. You can write down. So violation of conditions. Violations of conditions. Which is, first is apply to the purpose other than charitable or religious or against the objects of the trust. Okay. So violation of conditions will result in the deemed income. This will be my deemed income of the previous year in which condition is violated. That is one. Second violation is it ceases to be accumulated. It ceases to be accumulated. Then the income, this will be deemed to be the income in the previous year in which income ceases to be accumulated. Or it ceases to be remain invested. It ceases to remain invested or deposited in any of the modes specified in section 11(5). Then it will be deemed to be the income of the previous year in which income ceases to be invested as per section 11.5, or it is not utilized for purpose for which it is accumulated. It is not utilized for the purpose for which it is accumulated. Then, in this case, will be deemed to be the income of the previous year in which the last previous year of the period. We can write like this: last previous year of the period. So what do we mean by this particular scenario? So let's take for an example that I have invested the amount for 5 years. I have accumulated the amount. So let's say this is 23-24. So I'll start with that. You can write period for which it is accumulated. Let's say example 5 years. Okay. So now I am into the previous year 23-24. So I have accumulated for 5-year period. I have accumulated for 5-year period. Okay. Now in this 5-year period, let's say I am not utilizing for these 5 years. Then it will be deemed to be the income of the last previous year in which the accumulated income is not utilized beyond the period. Are we getting that? So here, this shall be 27-28. This is including this year that we have 5 years. So deemed income of the last previous year up to which accumulation was allowed. Okay, up to which the accumulation was allowed. Or last point is, what are the violation of the condition? The income is credited or paid to any other trust income is credited or paid to any other trust. This will be deemed to be the income of the previous year in which amount paid to another trust. Okay. So basically, what did I tell you? That you can accumulate the 85% of income for the period of maximum 5 years by stating the purpose for which you want to accumulate. That will be considered as deemed application for the previous year, for the current previous year. And you have to file the form 10 by the due date of 2 months prior to the 139 month. Now, even if you file the form 10 by the due date of 139 month, it is still fine. We will give you the deemed application. That is only available in this case where you have to accumulate the income. And till the time you deposit the amount for the specified purpose, you have to invest in the section mode specified in section 11.5. You also have to file the return of income. Now, if you do not use the amount for the specified purpose, you give it to some other trust, or you do not invest in section 11(5) modes, or you apply for the purposes which is not in line with the objects of the trust, or you do not accumulate the amount. So if you violate any of these conditions, it will be deemed to be the income of the year in which you violate the condition, except when you do not utilize the amount for that 5-year window that you have, then it will be deemed to be the income of the year in which you have, up to which the time limit was allowed to you to accumulate. So the last period for which the accumulation was allowed, it will be deemed to be the income of that year, if you are not utilizing for the purpose for which it was accumulated. Clear? So this is the deemed income that you will have. Yes or no? Any doubt, any questions? Is it clear? All the students, are you with me? Yes or no, students? Yes or no? Any questions, any doubt? So the assessing officer in this particular case can deny you the benefit. Okay, in case you are not applying the income for which you have accumulated. Okay. So if you are not if you are accumulating the income and not utilizing within that 5-year window what you have got, then in that particular case, the assessing officer will deny you the exemption. This will be considered as deemed income. Are we clear? Yes or no? So it will be deemed to be the income of the year in which the last previous year of the period for which the income is not utilized. Clear, students? Yes, everybody. I'm not getting answers. I understand this is little trickier, but you have to answer me because only then we can proceed forward. Yes or no? Faster. Yes or no, students? Okay, fine. Very good. Okay, let's proceed further. Now we are again on the application of the income. We are on the application of the income. So we have considered first the cases of the deemed application. We have considered the cases of the deemed application. Fine. Now the actual application. This was the case of the deemed application. Now we are talking about the actual application. What is allowed as actual application? So here you can write, first scenario was under the application. This was my deemed application, under which we considered the 3 scenarios. Okay. Now, next is expenses. So I will be allowed the expenses for whatever expenses I will be incurring for the trust, that I will get the application of income. But there are certain restrictions which are there. So what are the restrictions which are there in terms of the expenses which are allowed to the trust? So just write down. So I will write in this way. Allowed. And on this side, I'm writing disallowed. Allowed and then disallowed. Okay. So as I said, I will be allowed the expenses which are operational expenses. However, what expenditures I'm not being allowed? So like under your PGBP, you have certain disallowance of the expenditure. Here also you will be having the disallowance where the TDS has not been deducted. So where the TDS has not been deducted or deducted but not paid. So the same way we have section 40A1A under the PGBP that is equivalently applicable over here as well. So in case any expenditure is there which is incurred on which the TDS is deductible and the TDS has not been deducted, or after deduction the TDS has not been paid before the due date of return of income, then 30% of the sum paid would not be treated as application of the income. So just write down section 40A1A applicable, which is TDS not deducted or deducted but not paid. 30% of the expense is not considered as application. Okay. However, this will be available to you. Considered as application of the income of previous year in which the TDS is deposited, in which the TDS will be deducted and paid. And paid. This is TDS not deducted or deducted but not paid, which is before the due date under section 139. Okay. Next is where the trust incurs any expenditure in cash other than account paycheck, bank draft, ECS or internet banking, which is more than 10,000. So that is not considered as application. Cash expense greater than rupees 10,000. This will be not considered as the application of the income. Now, understand one very, very important point over here, which is the expenditure will be allowed to you irrespective of the method of accounting you are following, only on the payment basis. So expenditure incurred but not paid will not be allowed to you as the deduction. Are we getting this particular point? So the expenditure here is not allowed to you on the incurrence, but the expenditure is allowed to you only in the year when you are making the payment of that expenditure. So expenditure shall be allowed or will be treated as application of income only in the previous year when you actually pay the sum irrespective of the method of accounting followed by you. Are we clear? Okay, so just write down. Expenditure allowed only when actually paid irrespective of the method of accounting. So basically here, if the expenditure is incurred but not paid during the previous year, shall not be considered as the expenditure of the year, as not the application of income. It will be considered as application of income in the year when you paid. Okay. So here I can give you a quick summary. You can make a very small chart at the end. So method of accounting. So if let's say for example you are following the cash system, then for the income you will recognize on receipt, and the expenses you will also recognize on payment. There is no problem here. But as far as the accrual system of accounting is concerned, for the income, here you will recognize on accrual, right? But if the income is not received, it will be considered as deemed application subject to the filing option in Form 10. And as far as the expense is concerned, this is not allowed as application unless actually paid during the previous year. Yes, students. Yes, Anish, the time limit of 5 years that is there for the accumulation of the income. As I said, you have to accumulate the income for a maximum period of 5 years. Now, how do you have to count that 5 years? So you have to include that particular current year as well. Okay. So that 5 years which is there, that window which is there, that is including the current year and not excluding that year. Okay. Yes. Fine. Any other question? Yes or no, students? Is it clear? Is the expenses part clear? Operational expenses, are we clear? Depending on the method of accounting, irrespective of that, it is going to be only on the payment basis. Yes or no? Okay. Yes, students, faster. Are we clear? Okay. Now the next one, which is allowed, is the expense, which is capital asset, the purchase of the capital asset. So capital asset acquired during the year is also considered as the application of income. So capital asset acquired is considered as the application of income. What is disallowed is the depreciation on the capital asset. So the depreciation on capital asset will not be considered as the application of income. The depreciation on capital asset will not be considered as the application of income. So only the capital asset which is actually purchased, when that is being allowed to you as the application of income, then why you will get the depreciation. See, similar thing is there under 35 AD also. You get the entire amount as deduction under 35 AD of the capital asset. Then you don't get additional depreciation also there. Similar thing is available over here. So basically, when you get that deduction of capital expenditure, you will not get the depreciation on that particular capital asset. Yes or no? Fine. The next one is, okay, the next one is, what is the next particular application of income? The next particular application of income here, it is allowed is the repayment of the loan or the borrowing. Repayment of the loan or the borrowing. So, if let's say for example, I have taken a loan or a borrowing and I am making the application from that loan or borrowing. Let's say I have borrowed a loan of rupees 10 lakh. Now I am utilizing that loan, let's say for the purchase of capital asset. Then that will not be allowed to me as a deduction. Are we getting that point? So that is not going to be allowed to me as a deduction. What is going to be allowed to me as a deduction over here is the repayment of the loan. So when I will take the loan, at that time when I'm applying the amount from that, that will not be allowed as the deduction. Only when I will repay the loan, only when I will repay the loan, only that will be allowed to me as the deduction. Are we getting that? So, when you take the loan, that will be, any application out of that will not be considered as application. When you repay the loan, that will be considered as application. So, just write down over here. So, just write down repayment of loan or borrowing will be considered as application. And what is not considered as application is the application from the loan borrowed. So the application from the loan borrowed will not be considered as the application. But what is considered as application is the repayment. Okay. So just write down now here one more important point with regard to this repayment of the loan, where there is an amendment on this particular point itself. So when I'm saying that the repayment of the loan is not allowed, the repayment of the loan is not allowed, but in this particular case, you're only allowed, so the repayment is allowed and not the application out of that. In these cases, what was happening is, since this particular point which is there was being misused by the trust. So here they have introduced this amendment. They say that the amount shall be treated as application in the previous year in which the loan or borrowing is repaid, subject to the satisfaction of the condition. What are the conditions? That the application should be only in India. The application from the loan or borrowing which is being made should not be in the form of corpus donation to any other trust. So the loan or borrowing should not be utilized for making the corpus donation to any other trust. And if any application is being made for any expenditure, the TDS should be deducted on the same. If the application from the loan or borrowing is made for any expenditure, that expenditure should not be in cash for more than 10,000. Are we clear? The application should not be made from the loan or borrowing for the benefit of any related party. And lastly, The repayment of the loan should be made within 5 years from the end of the previous year in which the application was made from the loan or the borrowing. Are we getting this particular point? See, interest on loan repaid, yes, that will be considered as application. That will be considered as application, Satish. So it is not that that will not be considered as application. Okay? So just write down here the condition. These conditions were not there up till now, but these have been introduced by the Finance Act 2023. So this has been the latest amendment for you. Because earlier what was happening, there was no track in terms of the repayment of the loan or what is the utilization of the loan amount. It was just allowed like that without any check on that. So now they have introduced this condition that the repayment of loan will not be considered as application. This is now condition. And what are the conditions? The application can write loan should, or you can write the application of loan the application of loan conditional on application of loan. Let's write like that. First is the loan should not be utilized for corpus donation to another trust. For corpus donation to another trust. Secondly, loan should be applied in India. The loan should be applied in India. Third one, TDS should be deducted on expenditure applied through loan. The expenditure through loan should not be in cash greater than rupees 10,000. The application should not be for benefit of specified person under section 13. Okay. And the repayment of loan should be made within the 5 years from the end of the previous year in which the application was made from the loan. Application was made from the loan. Yes. So basically, within the loan should be repaid within the 5 years from the year in which the loan was utilized to meet out the expenses for the trust. So if, let's say, for example, the loan is utilized in the previous year 23-24 for meeting out the expenses of the trust, then it has to be latest repaid by March 31st, 2029 within the 5 years window. And if it is not repaid, then it will not be considered as application. It will not be considered as application. Are we clear? Now the next application that we have to consider, loan repayment or borrowing. After that, the next is the amount reinvested in the modes specified under section 11.5. So basically, if you apply the amount for the corpus donation, so any amount paid towards the corpus donation is not considered as the application of income. Any amount paid towards the corpus donation is not considered as application of income. So if it is not considered as application of income, then that particular amount will not be allowed. So corpus donation which is utilized by the trust towards its object under both the regime, since the corpus donations received are exempt, therefore corpus to any application made from the corpus donation also will not be considered as application of income. If the amount of corpus donation, amount received towards the corpus donation is exempt, any application from the corpus donation is also not considered as the application of the income. However, it is considered as the application of the income in the year in which the amount is invested or deposited into the mode specified in section 11.5, which is maintained specifically for that corpus. So, for example, let's take an example to understand that. Let's say a trust is there, right? If the trust basically has the amount deposited in the corpus, let's say it has received 10 lakh rupees as a voluntary contribution with a specific direction that it shall form part of the corpus of the trust. Whether that will be considered as income, students? Answer is no. That will not be considered as income. Right? So when you receive the voluntary contribution, what did I tell you? When you receive the voluntary contribution, what did I tell you? Any voluntary contribution received towards the corpus will not be considered as your income. So let's say you received 10 lakh, that will not be considered as your income. Now, when you deposit that amount, that amount is, you have to, when you receive that corpus amount, you have to deposit that amount under section 11 as per the modes described in the section 11 subsection 5. Are we clear? So it is not going to be chargeable to your income in the previous year 23-24. Now let's say, for example, out of this 10 lakh rupees, to meet the expenses of the current year, let's say you are utilizing rupees 4 lakh and you are withdrawing from the mode specified in 11.4. Now, let's say you have utilized that 4 lakh. Now, the 4 lakh will not be treated as application because it is withdrawn from the corpus. But let's say, for example, in the next year, you are receiving an income of 3 lakh. Let's say you are running a school, you are receiving an income of 3 lakh. Now, if you get 3 lakh, you are investing in the corpus fund. You have withdrawn 4 lakh. Now you are reinvesting back, let's say 3 lakh rupees. that will be considered as the application of the income. Are we getting that? Yes or no? So, here you can write down the example. Amount withdrawn from corpus is not considered as application of income. So let's say rupees 10 lakh received as voluntary contribution with direction that it will form part of the corpus. Now, if invested in modes in section 11.5, then this is not income of the previous year, 23-24. Now, let's say, for example, out of rupees 10 lakh, I withdraw rupees 4 lakh for utilizing for expenditure of trust. Now, this is not considered as application. But let's say, for example, if in previous year 24-25 income of rupees 3 lakh deposited in mode in section 11.5 specified, this will be considered as my application. This shall be considered as my application. So basically, what is my application? Income deposited in modes specified in section 11.5. But the amount withdrawn from the corpus will not be considered as my application. It is similar to loan or borrowing only. See, for the loan or borrowing also, let's say, for example, you are taking 10 lakh loan. Now, out of 10 lakh loan, you are utilizing, let's say, rupees 3 lakh for the expenditure. That is not considered as application. When you repay that 10 lakh, that will be considered as the application. Similar thing is for the corpus. Now, again, here also there are amendments to this particular point because this was also being misused. This was also being misused. So now they are saying, Geeta, the last point that I mentioned is that when you are withdrawing from corpus and utilizing for any expense, that is not application. But let's say when I'm earning the income and depositing back in the corpus in the mode specified in 11.5, that will be considered as application. Is that clear? Again, here also the similar points are there. That now when you deposit into the mode specified in 11.5 into the corpus, now that will be considered as application of the income subject to these conditions. These conditions were not present until last year. You can write here maintained for corpus. Subject to the conditions. And what are the conditions? That the application that was made from the corpus should not have been for corpus donation to any other trust. It should have been only utilized in India. If any expenditure was paid, the TDS should have been deducted on the same. Any expenditure should not have been in cash. The application should not have been for the benefit of any related person or specified person. So the same conditions which are applicable for the repayment of the loan are applicable over here. Same conditions. Are we getting points? So I'm just copy pasting the conditions over here. Okay. Now this again has been amendment from the Finance Act 2023. Even for the loan borrowed, you can write the example. Example, rupees 10 lakh borrowed and rupees 3 lakh utilized for expense. Rupees 3 lakh not application. So what is my application is, if let's say rupees 5 lakh repaid, this will be the application of income. Yes or no, students? Any questions, any doubt? Okay. Yes or no? Fine. Now the last application of income, which is donation to another trust. If I am making the donation to another trust, that is again considered as the application of the income, provided the donation should not be towards the corpus of that trust. Okay, so donation to the trust should not be towards the corpus of that trust. If I am donating the amount by way of corpus donation to any other trust, that is not considered as application of income. Any other amount that I am donating to any other trust, that is considered as application of income, irrespective of the objectives of that other trust. But that trust should be registered under 1023C or 12AA or 12E. Okay, so you can write it over here. Donation to any other trust, irrespective of its objective. Okay. Donation to any other trust, irrespective of its objective. Okay. So what is not allowed is donation to the corpus of the trust. Donation to any other trust, you can write down. Registered under 12AB or 1023C. Okay. Also, one more important point. If you remember, I told you here, when you have to accumulate the income, I told you over here that when you have to accumulate the income, that 85% of the income that you accumulate, out of the accumulated income, you cannot contribute to any other trust, whether corpus or non-corpus. So here, if you remember, I told you, it is credited or paid to any other trust. So if you pay the amount from the accumulated income to any other trust, then it is not considered as application of income. So meaning, I am allowed to pay to any other trust, but it should be out of the current year income. If it is out of the accumulated income, then it is not considered as application. Then you are violating the condition itself. In fact, it will be treated as the deemed income. So you can write donation to the corpus of the trust or donation out of the accumulated income will result in violation and deemed income. Okay? Yes or no? Fine. Now, again, this particular point was being misused by many taxpayers. Donation to another trust. So how is it misused? I'll tell you. Simple, very logical thing. So let's say, for example, you are being given rupees 1 lakh. Okay? You are being given rupees 1 lakh. Okay? Now, what you will do, let's say you are allowed to transfer it to another trust. And that will be considered as the application of income. That will be considered as application of income, right? Now, let's say, for example, how much you will apply it for the another trust? Yes. Yes, how much you will get? Yes, students, faster. So you have, let's say, rupees 1 lakh. How much you will consider for the application of income? How much donation you will give to another trust? You can give 100%, right? But 15% is ad hoc. 15% is ad hoc exemption. So let's say rupees 1 lakh is the income of the trust. Rupees 1 lakh is the income of the trust. Now, from this 1 lakh, there is this ad hoc exemption of 15,000, right? So balance is 85,000. Now, the application to be made by donating to trust is 85,000. So this will be nil. Let's say this is trust A. Let's say there is trust B. Now this has received 85,000. This will be its income. It will calculate 15% of that, which is 12,750. Now how much it is? 72,250. Let's say it will donate to the third trust. Entire amount. This will be considered as the. Let's say there is trust C. Now this will have the income of 72,250. It will again keep ad hoc amount of 10838 and balance it will give it to another trust. So if you see at every stage, the 15% amount is getting exempted like that. And that is never getting applied at any stage. So to prevent that, this year onwards, they have said the Finance Act 23 has amended and it has provided that only the 85% of the amount donated let me write it over here, will be considered as application. Restricted to 85% of amount donated. So donation to any other trust registered under 12AB or 2023C, irrespective of its objective, shall be allowed. But how much will be allowed? Only to the extent of 85% of amount donated. So here, instead of 85,000, this shall be 72,250. Here, instead of 72,250, 100% allowed, this shall be 61,413. Are we getting that? So here, this is how the application of income will be considered. This has been the latest amendment from Finance Act 2023. Are we clear? Yes or no? Fine. Now the last application of income. If you remember, I told you that capital gain is considered as the income over here, which will be your sale consideration minus the cost of acquisition. Now, when let's say for example, when you do the normal capital gain for any taxpayer, when you reinvest the amount in specified assets, you get exemption under 54 series. Here also you will get deemed application for the reinvestment of the capital gain. So here also you get the specified deductions. You will consider it as application of income when you reinvest the amount of the capital gain. So where you have transferred the capital asset and now you have utilized that amount for acquiring a new capital asset, which is used for the charitable or religious purposes, then you will get the deemed application of the income. Now, if you utilize the entire amount, you will get the entire amount as the application. Let's say my sale consideration is 5 lakh. Expenses on transfer is 1 lakh. So that will give me the net sale consideration as 4 lakh. Index cost 2 lakh. Let's say the capital gain is coming to 2 lakh. Let's write an example over here. You can write here deemed application for capital gain. Let's take an example. Let's say sale consideration is in this case, let's say 1,50,000. Okay. Let's say my cost of acquisition or whatever the index cost is, 1 lakh. Okay. So net my capital gain here is 50,000. Now, let's say for example, I have three different situations. Sorry. We invested entire cost. We invested the amount. We invested the amount for the acquiring the where the whole of the consideration is utilized for new asset. We invested entire sale consideration for acquiring new asset. Let's say in this case, I have purchased the capital asset worth rupees. The entire sale consideration is 1.5 lakh. Then this will be considered as the application under section 11(1)(a). Up to rupees the capital gain amount. Of course, I cannot consider the entire amount, but here to the extent of the capital gain, let's say rupees 1.5 lakh is the cost of new asset. Therefore, deemed application, my deemed application shall be to the extent of the capital gain. Which will be rupees 50,000. Which will be rupees 50,000. Okay. But let's say, for example, I have invested the cost of the new asset which is acquired is partly. Here I have to add little space because it was crumpled. Let's say part consideration is reinvested for new capital asset. Okay. Where I am reinvesting part of the amount. Let's say 1.2 lakh rupees. Now in this case, like you had under the 54F, where you used to have whether the cost of the new asset is less than the net sale consideration or it is more than the net sale consideration. You have to see that. Where the cost of the new asset is less than the net sale consideration, then in that particular case, the application which is going to be here, let's say I have purchased the capital asset of 1.2 lakh. Then the application shall be excess of the proceeds utilized over the cost of the new asset. No, ma'am, we didn't get it. So basically, let's say if it is 1.2 lakh, so 1.2 lakh minus the capital gain amount of 50,000. So cost of new asset minus the cost of the old asset, that will be considered as the application of income. Are we getting that point? So let's say here I have 1.2 lakh which is considered as the cost of the new asset. Let's say rupees 1.2 lakh as cost of new asset. Then it will be, the application will be cost of new asset minus cost of old asset, which will be 1.2 lakh minus 1 lakh, which will be 20,000. It shall be rupees 20,000. Okay. So where the part of the capital asset, where the cost of the capital asset is less, then in that particular case, you will get the difference between the cost of the old asset minus the cost of the new asset. Sorry, cost of new asset minus cost of old asset. That will be considered as the application of income. Are we clear? Yes or no? Okay. Any questions? Any doubt? Yes or no? Fine. And let's say, for example, where a part asset is transferred, where only a part of the capital asset is transferred, then only the appropriate fraction of the capital gain will be deemed to have been applied to the charitable or religious purpose. So let's say, for example, if the 2/3 of the income which is derived from capital asset is only utilized for charitable purpose, and let's say the cost of the asset is 1.2 lakh, the consideration is 1.8 lakh. So the capital gain will be 60,000. Right? Now I am utilizing only 2/3. So 2/3 of 60,000 will only be capital gain, which will be 40,000. Now let's say I'm investing in a new asset. So in that case also I will only consider the 2/3 of that and not the entire amount. Are we getting that? So I will only consider the 2/3 of that and not the entire amount of capital gain. Clear? And even for the application purpose. Yes or no, students? Any questions? Any doubt till now? Yes. So shall I give you one question? Can you just write it down or take the picture of that question, because I want you to solve that question. And now see, what we are remaining is the section 13 violation. That is one thing we have to do. Then we have the accreted tax, which is the exit tax and the specified income taxation that we have to do, and the registration requirement. 4 things we are left with. Now this we will be directly doing in our next class, which will be taken by me on 20th. If the cost of the new asset is less than the cost of the old asset, then in that particular case, you will not have the application of income. See, when, let's say for example, you have in this case, let me take this scenario. See, here you have 1.2 lakh. Now, let's say for example, I have applied to the extent of, let's say 1 lakh. And my sale consideration is how much? 1.5 lakh. So I have applied lesser amount than the cost. I have applied the lesser amount than the cost. So in that particular case, what will be the scenario? So in see that case, you have to ask a question whether the cost of the new asset which is there, if that is less, then the entire amount will be considered as application. Then the entire amount will be considered as application. Of course, to the subject to the capital gain amount. Okay? Yes or no? Fine? Yes. Because then you are, in that case, applying even lesser than the cost of acquisition. Okay? Any doubt? Any question? So the balance topics which are there, we will be covering in the next class, which we will be having on 20th directly. Of course, you have the classes now on TDS and TCS for the coming lectures, which I will not be taken by me. So now what is left is, as I said, we are left with the registration of the trust, the deemed income and the accreted tax which is there, and finally the political parties. That is of course like 10 minutes topic, But that is what is left now. So these are the 2, 3 things which are left. Other than that, we have completed everything. Okay? Yes or no? Any questions? Any doubt? Yes, students. Okay, fine. So we'll stop it for here and we continue in the next class. Yes, Krishna, your notes will get uploaded by tomorrow anyhow. Yes, Mansha, you have to revise. This is very important topic and you cannot skip it. Absolutely no skipping. And let me just give you the question before we close the session. No. 1 second. Please take this question, students. Copy this question or take the picture shot of this question because we are going to solve this in the next class. This is very important question. Okay, students. So you can take the picture of this one. Once you are done, let me know. Okay, done. Fine. So thank you so much. Now we meet directly next week, I think on Monday. Okay. Thank you so much, students. We can close the session.